You're looking at a stock that is down 35% this year.
Right.
It's flashing these relentless bearish signals on the charts, and it is just burning through hundreds of millions of dollars in operations.
Oh, yeah. Like an absolute bonfire.
Exactly. But yet sitting right next to that cash bonfire is this massive multi-billion-dollar mountain of cash.
Yeah.
And you've got this vocal contingent of analysts calling the company fundamentally undervalued. So what's the real story here?
It is honestly the ultimate market paradox. We're looking at a balance sheet that's built like an absolute fortress,
Yeah.
but it's paired directly with an income statement that looks like a five-alarm fire.
Welcome to the Deep Dive. Today is Tuesday, April 14th, 2026, and we are putting Joby Aviation ticker symbol JOBY under the microscope.
Should be a fun one.
Oh, definitely. The mission for this deep dive is to sift through the raw financial data, the technical order flows, and, the market news. We need to figure out if this flying car pioneer is a brilliant value play for you, or if it's just a classic retail value trap.
Right, because there's a huge difference.
Huge difference. And just a crucial reminder before we dive in, this analysis is strictly for informational and educational purposes. We're looking at the sources, we're looking at the data, but absolutely nothing we discuss today constitutes financial advice.
Yeah, please do your own research, folks.
Always. Okay, let's unpack this.
Yeah.
Before we even consider where the stock price is headed, we really need to look under the hood at the financial engine driving this whole thing.
Yeah, because we're analyzing a company that's actively attempting one of the hardest maneuvers in business, really.
Transitioning from a startup to a real business.
Exactly. Going from a pre-revenue research and development startup into a fully operational commercial aviation company.
Which is no small feat.
Not at all. And looking at the trailing 12 months leading into fiscal year 2025, the income statement paints a very stark picture.
Yeah, I mean, the total revenue sits at just $53.43 million.
Which isn't much in the aviation world.
Right. And for a company building eVTOLs, which are essentially electric vertical takeoff and landing aircraft or, electric flying cars.
Flying cars, yeah.
You might wonder how they're generating $53 million without an actual commercial passenger network up and running.
Well, that top line number is heavily subsidized by the Department of Defense.
Government money.
Yeah, exactly. We're looking at early military contracts, specifically through the Air Force's Agility Prime program. Plus, they have some legacy conventional helicopter services they run.
Kind of like an operational proof of concept for their ElevateOS software, right?
Right.
Yeah.
Which is a solid proof of concept, sure, but that $53 million in revenue is completely eclipsed by the operational costs. I mean, Joby posted a staggering net income loss of negative $929.84 million.
Oh, wow. Almost $1 billion.
Yeah, an earnings per share of negative $1.13. So they are burning nearly $1 billion a year.
That is wild.
It is. But to really understand the mechanics of that burn rate, we have to look at the massive safety net holding them up.
The cash pile.
Exactly. As of February 2026, Joby is sitting on approximately $2.6 billion in cash and short-term investments.
That is a massive cushion. Because looking at their balance sheet, their total assets sit at $1.79 billion as of year-end 2025, against only $385.36 million in total liabilities.
Right.
So their liabilities are just a tiny fraction of what they hold in liquid assets.
It creates this really fascinating tension, especially when you look at the 52-week range.
Oh, the market has given a severe whiplash here.
Absolutely.
The stock hit a high of $20.95, but it also cratered down to a low of $5.61. And today we're sitting at $8.69.
Which is quite a drop from $20.
It is. And looking at that $1 billion burn rate, I just have to wonder about the efficiency of that cash pile. It reminds me of like a college student with a multi-billion-dollar trust fund, but a massive daily spending habit.
That's a great way to put it.
Right. Because $1 billion in net losses means that $2.6 billion isn't infinite. So I have to ask, are they genuinely capitalized enough to reach commercialization, or are they just kicking a very expensive can down the road?
Well, what's fascinating here is the specific cost curve of aerospace engineering.
Okay, tell me more.
The high R&D and manufacturing ramp-up costs are not a bug, they're a feature. They're entirely expected for a pre-operational aerospace company.
So it's not like a tech startup.
Exactly. They aren't building a software as a service product where your primary expense is just, server space and some developers.
Right, they are bending actual metal.
Yeah, They're engineering brand new aviation hardware from scratch. They are building physical composite manufacturing facilities in Ohio and California. Plus, they're running these incredibly expensive, destructive testing protocols.
So the cash pile is more like a runway.
It is a meticulously designed runway, yes.
Ah.
The market fully priced in the cash burn. The underlying anxiety we're seeing in the stock price right now reflects a deeper fear.
Which is what?
That the cost curve accelerates exponentially as you move from digital blueprints to mass manufacturing physical airframes.
That makes a lot of sense.
Yeah.
And that anxiety is clearly bleeding directly into the technical analysis and the order flow we're seeing on the charts right now.
Oh, the charts are a mess.
Totally. So today, April 14th, the stock is trading at $8.69. It's shown an intraday gain of about 4.2%, which is 35 cents.
Nice little bump.
A nice little bump, yeah. But when you zoom out, that short-term strength is entirely trapped inside a brutal long-term macroeconomic downtrend.
Right.
Being down 35% year-to-date in 2026 means the stock is trading well below its 200-day moving average, which is towering way overhead at $13.69.
Yeah, the support and resistance levels establish a very tight, highly pressured channel right now.
Where are we seeing support?
The immediate support, like the floor where institutional buyers seem willing to temporarily step in, is anchored heavily around the $8 psychological level.
Okay. But the upside is capped, right?
Heavily capped. Resistance is looming right at the 50-day moving average, which is $9.54. Any attempt to rally is immediately met with selling pressure right at that line.
Interesting. And looking at the momentum indicators, the 14-period relative strength index, the RSI, is currently at 65.10. That pushes Joby dangerously close to short-term overbought territory without actually having broken out of its bearish structure.
Yeah, but the real story there is in the volume divergence.
Oh, absolutely. So midday volume on April 13 was 20.92 million shares, which sounds like a lot, but that is actually roughly 21% below the 3-month average of 26.6 million shares.
Which is a huge tell.
Right. Because, wait, if we're seeing intraday strength today, but trading volume is plummeting 21% below the average, isn't that a red flag?
Yeah.
Like, is this short-term strength just a mirage in a long-term downtrend?
You've identified the exact mechanical flaw in this recent price action.
Okay, explain that.
When price goes up but volume goes down, the rally is hollow. Institutional capital, the pension funds, the major asset managers, they are basically sitting on their hands.
They aren't buying it.
No. There's high buy and sell tension, violently concentrated strictly between $8.03 and $8.57. The major players are just letting high-frequency trading algorithms battle it out in a 50-cent channel.
Wow. Just waiting for clarity.
Exactly. They are waiting for fundamental clarity.
And I guess that institutional hesitation explains the massive, almost comical spread we're seeing in the analyst ratings and price targets.
It's all over the place.
It really is. The overarching consensus among major financial institutions is generally a lukewarm reduce or neutral.
Right.
But when you look at the 12-month price targets, the average sits at $11.90.
Yeah.
Yet it's constructed from this chaotic spread between a low target of $6 and a high of $18.
Institutional analysts are staring at the exact same balance sheet and coming to entirely different conclusions.
Yeah, how do you even value a pre-revenue aviation company?
Well, you can't use the old models. Traditional valuation metrics completely break down in this sector. I mean, Joby's trailing price-to-earnings ratio is negative 9.13.
Ouch.
Right. On legacy metrics, they are fundamentally uninvestable. You're valuing a company based purely on discounted future cash flows that do not currently exist.
Which requires a lot of imagination.
Yeah. And when institutions cannot reliably model those future cash flows because the regulatory pathway is so uncertain, you get this massive spread in price targets.
And the insiders seem to be signaling their own lack of patience here, too.
Oh, the insider selling.
Yeah, over the last 90 days, corporate insiders have liquidated approximately 1.33 million shares. That's pulling roughly $13.8 million out of the stock.
Right.
Now, sure, even if a portion of those sales are pre-scheduled 10b5-1 plans to cover taxes on stock-based compensation, the sheer volume of shares hitting the open market creates a persistent, heavy headwind for the stock price.
It absolutely does. And this dynamic brings us to the core debate facing the listener.
Here's where it gets really interesting. Is this an attractive entry point near yearly lows for long-term believers? Or is it a classic retail value trap?
The psychology of the value trap is so vital to understand here.
Because retail traders love a discount.
Exactly. A retail investor opens their brokerage app, sees Joby was trading at 20.95 cents last year, sees it today at $8.69, and their brain relies on anchoring bias.
They anchor to that previous high.
Right. They assume the stock is quote-unquote on sale at a 60% discount.
But they completely ignore the deteriorating fundamentals that caused the 60% drop in the first place.
Yes.
They ignore the bearish momentum. They ignore the volume divergence, the negative signals from the recent insider selling.
Just because a stock used to be expensive does not magically make it a bargain today.
Exactly. So to really determine if Joby is a trap or an opportunity, we have to stress test the specific catalysts. We need to measure the mechanisms of the bear case against the mechanisms in the bull case.
Let's start with the bears.
Okay, looking at the downside risks, the high cash burn is obvious. But the silent killer of shareholder equity here seems to be the relentless, punishing share dilution.
Dilution is just the inescapable gravity of pre-revenue hardware companies.
It really is.
When Joby needs to fund that billion-dollar annual burn rate, they issue more equity. Over the company's public lifespan, the number of shares outstanding has ballooned from roughly 604 million to over 874 million shares.
That is massive.
Yeah.
Diluting the stock at this phase is like trying to fuel an airplane while you're already in the air.
That's exactly what it is.
Yes, it keeps the engines running, but the sheer weight of all those hundreds of millions of new shares makes it infinitely harder for the stock price to actually gain any altitude.
Right, because the float is just too heavy.
Exactly. Even if the broader market rallies or Joby releases positive news, that massive float suppresses the price action. Your individual slice of ownership in the company is continuously shrinking.
And then you have to add the severe regulatory hurdles for FAA certification on top of that. The bear case is incredibly formidable.
Yeah, I mean, it's like building the world's most advanced race car, but having to wait for the government to invent the concept of a paved road.
That's brilliant because the Federal Aviation Administration does not move at the speed of Silicon Valley. And that culture clash is the biggest risk on the board.
Because they're asking the FAA to certify something entirely new.
Entirely novel. There is no existing framework for commercial electric vertical takeoff aircraft flying over densely populated urban centers. The regulatory delays aren't just possible, they are an inherent part of the timeline.
So let me ask you this. If they dilute the stock by another 200 million shares while waiting for the FAA to invent these rules, does it even matter to the listener if the planes eventually fly?
That is the real danger.
Right. Because the underlying company might succeed in 2030, but the 2026 retail shareholder might be entirely wiped out by the dilution required to get there.
That is the bull-bear tension right there. But the bulls are looking at that same timeline and pointing to an entirely different set of catalysts for a recovery scenario.
Okay, lay out the bull case for me.
Well, beyond the massive $2.6 billion cash reserve, the recovery scenario leans heavily on their strategic manufacturing partnership with Toyota.
Right, the Toyota deal.
And this isn't just Toyota cutting a check. This is the integration of the Toyota production system into bespoke aerospace manufacturing.
Which is huge because building one prototype is totally different from mass production.
That is the most crucial distinction in the entire bull thesis. Building one perfect prototype flying car is a fun engineering challenge. Building hundreds of them a year with flawless safety tolerances is a grueling mass manufacturing challenge.
And Toyota knows mass manufacturing.
Better than anyone. They bring decades of supply chain mastery, defect production, and high-volume composite curing processes right to the factory floor.
Oh, wow.
Yeah, Toyota engineers are physically on the ground at Joby's facilities, helping them transition from a boutique engineering lab into a real commercial assembly line.
So it's a massive operational moat.
Exactly. Almost none of their competitors possess that level of manufacturing partnership.
And that operational moat sets the stage for their most immediate revenue-generating catalyst, which is the near-term commercial launch in Dubai.
Yes, the Dubai launch is critical.
They are essentially building a bespoke, futuristic transit system in a regulatory environment that is actually highly motivated to make it happen.
Right, the UAE wants to be first.
So, having weighed these massive risks against the massive potential, we really need to break down the exact timeline the listener needs to watch. What is the short-term outlook here?
Okay, so short-term meaning the next few weeks. The fundamental story doesn't matter as much as the upcoming volatility.
We've got earnings coming up, right?
Yep. All of this tension, the low-volume rallies, the resistance at the 50-day moving average, it's all compressing like a coiled spring leading into their Q1 earnings report, which is scheduled for May 6, 2026.
So we can expect high volatility. The stock is probably going to bounce violently between that $8 support and $9.54 resistance as traders position themselves for the data drop.
Oh, absolutely.
But looking at the medium to long-term outlook, the operational milestones are essentially split across two entirely different continents.
Yeah, if we connect this to the bigger picture, it is wild. In the Middle East, the timeline is highly aggressive.
How aggressive are we talking?
Well, early 2026 is slated for the completion of the physical infrastructure, specifically the Dubai International Airport vertiport.
Okay, so the buildings are going up.
Right. And that infrastructure directly enables their targeted commercial passenger launch in late 2026.
Late 2026, that is just around the corner.
And here's the kicker. Dubai has given them exclusive rights to operate air taxis in the Emirate for 6 years.
Oh, wow, a monopoly.
Exactly. Which means if they launch successfully, they immediately capture a highly lucrative, monopolistic revenue stream.
But meanwhile, domestically in the U.S., the entire focus is on navigating the FAA's rigorous multi-step certification process.
Right, a totally different ballgame.
Joby is currently grinding through the most complex phase, which is the crucial Stage 4 certification.
And Stage 4 is where theoretical engineering meets harsh reality.
Because the first 3 stages were just paperwork, right?
Basically, yeah. Stages 1 through 3 were essentially agreeing with the FAA on the certification basis, the means of compliance, and the testing plans.
So what makes Stage 4 so difficult?
Stage 4 requires Joby to actually test conforming physical aircraft and system components to prove they meet those agreed-upon safety standards.
So things like structural testing.
Yes. This involves rigorous pilot-integrated flight testing, structural fatigue testing, and software validation. It is by far the most time-consuming and capital-intensive phase of the entire regulatory journey.
It sounds exhausting.
It is.
So what does this all mean? If we synthesize this entire battlefield for the listener, Joby Aviation's survival relies on walking a geopolitical tightrope.
That's a great way to summarize it.
Right. JOBY is a high-risk, high-reward battleground. They have to execute flawlessly in the Middle East to generate the commercial revenue required to sustain the company.
While simultaneously funding the grueling bureaucratic labyrinth of Stage 4 FAA approval here in the West.
Exactly. You have a company armed with $2.6 billion in cash, fortified by Toyota's mass manufacturing prowess, and staring down a near-term commercial launch in a wealthy market like Dubai.
Which is the ultimate bull dream.
But on the other side of the ledger, it's fighting a punishing 35% year-to-date downtrend, bearish technicals, insider selling, and an accelerating share dilution that just actively cannibalizes investor equity every single quarter.
Right. They have proven they can build an engineering marvel, but they haven't yet proven they can build a sustainable, profitable business around it without destroying shareholder value in the process.
Exactly. So as you, the listener, weigh whether that $8.69 price tag is the entry point of a lifetime or a classic retail trap, I know you had one final provocative thought to leave them with.
I do. Think about the scenario. If Joby successfully launches a booming commercial air taxi network in Dubai in late 2026,
Okay.
but the U.S. FAA Stage 4 certification process stalls out in endless bureaucratic delays for another 3 or 4 years.
Which is very possible.
Very possible. Does Joby effectively become a Middle Eastern aviation company that just happens to be headquartered and traded in the United States?
Oh, wow.
And more importantly, how exactly would Wall Street price a publicly traded American aerospace company that isn't legally allowed to fly passengers in its own airspace?
That is a staggering contradiction to think about, and it fundamentally changes the risk profile of the entire stock.
It really does.
Well, thank you for joining us on this deep dive into Joby Aviation. Keep questioning the prevailing narrative, always look past the surface-level numbers to understand the mechanics beneath the charts, and we'll catch you on the next deep dive.